I'm going to go through my latest. Whenever I give a talk, I'm always like, oh, I gave a talk, 6 weeks ago, 8 weeks ago. I can probably just update that. But this was actually, I think, a situation where for gold, things have changed enough in the last 10 days that I had to start from scratch. So, woe is me, I had to write a whole new presentation, and it is titled How Times Change for the Bullish. So, that didn't do anything. There we go. I really do think, I want to sort of paint a picture of what was and then where I think we are now and what opportunity that lays out for the next little while, and then beyond that, which is harder to see because I don't happen to have a crystal ball. But we had been living in a world that was pretty upside down and inside out, right? Inflation had been ramping, but gold wasn't paying any attention. Gold was near all-time highs, but gold equities couldn't get a bid. It was just a situation where every time we got a piece of news that should, on a macroeconomic fundamental basis, right, support gold, the opposite happened, right? Like you'd get signs, evidence that we have all this inflation and gold would fall. And it happened over and over and over. And it was very, frustrating for all of us who are interested in gold. And I think the reason all that was happening was because the only trade that was out there was getting ahead of the Fed, right? Everybody was obsessed, has for many years now been obsessed with rate hikes, and that was the dominant thing. Everybody was just just concerned about getting ahead of a rate hike announcement. And so we had this upside down, inside out situation. The Federal Reserve certainly understood that fear. They knew what was going on. Of course, inflation at 6%, 5.5% as it has been, means that they have to do something. And so they tightened without rate hiking, which was really a perfect solution. They tightened without the fear factor, right? The fear factor had been the thing. And while doing so, they promised that they won't hike rates anytime soon. And since we now live in a world where the Fed telegraphs its moves explicitly, clearly for months in advance, there's actually some credibility to that statement. So now this fear of rate hikes, I don't know where I'm supposed to point this to make it happen, maybe over there. I'm just sort of waving it around and keep pressing the button until it advances. Now, the fact that the fear of rate hikes has been alleviated, at least for a while, I feel like in the last 10 days, we are actually back to a fundamental relationship between sort of economics and gold, which is very relieving. I don't know how long it will last. I think, as I'm going to lay out, I think it's going to last for the next 4 months or so until, guess what, rate hike talk comes to the fore again. But a lot can happen in 4 months that can be pretty fun. So that's sort of my focus, at least for the near term. And this is certainly a chart of those last 10 days. And guess what? All of these pieces of news that support gold in a negative, as an inflation hike, as an inflation hedge in a negative real rate environment, those pieces of news caused gold to go up. It was a very gratifying set of reactions. There, maybe I point it behind me, just at the blue curtain. So yes, now I think we have a pretty clear runway for the next 4 months. Like I said, the taper move was the most telegraphed move in monetary policy history. Like, he told us that it was going to happen, and then he told us again, and then he told us again, and then he did it. And he did it at exactly the same pace that he told us he was going to do it. So the Fed, that's the Fed's playbook, right? They no longer are interested in the slightest in surprises. And so I believe that there will be no rate hikes anytime soon. Even though we have this pretty insane inflation rate, that's what they're going to do because surprises would hurt in lots of different ways. And so if we're not going to have rate hikes until getting on for the middle of next year, but we still have this pretty persistent, strong inflation, and there's lots of reasons to believe that next month's inflation print for this month will be even stronger than the very high numbers that we saw just a few days ago. I mean, then everybody, the talk of the street, we all see it, the talk of the street is how do you protect against inflation, right? And I'm not trying to say that gold is the only inflation hedge. There's always been multiple inflation hedges. I'm certainly not going to stand here and tell you that cryptos are not an inflation hedge. Try and fight that fight. Cryptos are a new entrance into the field of options, and absolutely, they can be an inflation hedge depending on your perspectives and how you play them and what role they take up in your portfolio. But what matters is that gold is the most proven inflation hedge, right? People aren't just going to throw out the idea of gold as an inflation hedge because there's a few new things that can also maybe play that role. And so I really do think in a situation where we have zero interest rates, really strong inflation, and no risk of rate hikes for the next little while, I don't think that gold could be better supported than that. And so that is a pretty exciting setup for the next 4 months. Just because, I mean, I don't spend a lot of time with technicals. I certainly don't draw them myself, but I like to pay attention to them when they show up in my inbox. This is Scotiabank yesterday. The technicals also look very good, which is exciting. So that supports some of these contentions about what might happen over the next 4 months. I don't make price goals for gold, but I think that we're going up from here for the next little while. So if this is what's happening, well, what do you do right now? I mean, those of us who are here likely have established metals portfolios already. And so, you know, we're not starting from zero and like building a new portfolio, but I do think that it's important to always, even if you love exploration stocks or, you know, usually just buy, you know, stocks that come from a particular group of people, take a step back and look at the situation here. Gold is about to make a big move. The gold miners and the gold sector stocks as a whole have been left behind. Gold has been trading at very high levels for the last year, but gold equities have not moved. They couldn't catch a bid. What is the first easiest thing to do in this situation? Well, it's to buy some of the big ones. And then as soon as those go, which they will, then you have those lovely returns that are, it's dangerous to use the word guaranteed, but they're getting on for, right? They have very little risk, and the potential for success is pretty strong. And then you have that play money again, if you want to call it that, to move into everything else that will get the next wave of buying. This isn't, I'm not, you know, recreating the wheel here. This is a proven approach. And so, I mean, I just put some options here. Kinross, B2, Integra, Nucor. I put their stock charts from the peak of gold last August down to where they are now, right? Are they likely to go back vaguely to where they were in August if gold goes back up, you know, to $2,000? I think that's a pretty reasonable expectation. There's 50% gains sitting right there for all of those in the next little while. So I have always loved exploration stocks, and I will always own lots of exploration stocks. I'm certainly not selling the ones that are in my portfolio, but focusing on buying in the near term will sit a little more, like in the next near term, will sit more with some of these easy opportunities. And then I plan to rotate that capital down into all of the more speculative stocks that I love so much. Now, what's going to happen 6 months from now? That's where things get a little bit foggier. It's very hard to know what's going to happen in 6 months, right? Will inflation choke out growth? Definite possibility, right? That's the kind of thing that inflation does. There's arguments out there that the strong labor market will carry us through the inflation. We'll see how that plays out. If inflation does persist, will the broad stock market suffer because inflation will hurt earnings? Or will it benefit because investors are trying to find somewhere to put their savings? And, you know, stuffing them into stocks is one way of protecting your savings in an inflationary environment. I don't know the answers to these. I wish I did. I don't. But you just have to rest on what you do know, which is that the Fed is still going to be expecting to raise rates in, you know, round about the middle of the year or in the second half of the year if inflation persists. Well, what's going to happen then? There's been this well-coined taper tantrum phrase, right? Well, I had to come up with a thing. So are we going to have rate rage? I mean, I think it's reasonable unless the economy is very strong, which it might be, but there's these inflation risks. Unless the economy is very strong, it's very likely that the stock market doesn't tolerate very much in the way of rate hikes, right? They can get pretty mad. We saw that happen in reverse. That's what taper tantrum was. They had been raising rates, then they layered tapering on top, and the market threw a fit, and the Fed backtracked and lowered rates. Is that likely in the opposite scenario? They did the tapering, they try and layer the rate hikes on top, and the market's like, no, we are now in a situation where we expect a lot of accommodative support all the time. I think that that's fairly real. of course supported by the fact that there's oodles of debt, and Fed governors have acknowledged openly that the new sort of ceiling for the federal funds rate is probably 2%, which is way lower than the 4% that it has averaged for such a long time, right? So even if we do have some rate hikes, they're not going to go particularly high. So that all leaves us in a situation where gold is well supported even beyond this 4-month window, right? Where I think in the 4-month window it's very well supported, and I think odds of it maintaining, of the rationale persisting beyond that, are pretty darn good. So that, but like I say, I'm not going to make promises about what's happening in 6 months, because that's, you know, a pretty cloudy outlook. Okay, that's been all gold. Gold is not the only thing that I like. Base metals certainly also matter, especially in a world of electrification where the demand increases here are really, really significant. I think it's important to remember that no rate hikes for the next 6 months also clears the way for base metals, right? The fear there had been that rate hikes would come in too early and they would choke off growth. And if you choke off growth, then you cut into demand for base metals, right? And so erasing, or at least putting off that fear, I think also clears the path for base metals to perform in this window. Are they going to perform as dynamically as gold? Well, no, because they are not an inflation hedge. But the electrification argument, the demand increases from electrification for, you know, big metals like copper and nickel, let alone some of the smaller metals involved in electrification, these are very, very real, very significant increases, right? I love to point out the incremental nickel demand from electrification. I mean, nickel has always been just stainless steel, right? Just stainless steel. Very huge industry, but sort of boring, right? Okay, stainless steel. The nickel demand from batteries is going to double the nickel market, right? That's an insane transformation. That's a paradigm shift for base metals. And, you know, similar, not quite double, but similar scale of impact exists for a lot of other metals. And so it's important to remember that that's the foundation. It's not going to be explosive and dynamic the way that I think gold is going to be in the next little while, but it absolutely makes sense. I also, just before I wrap up, I want to talk about M&A, because I think, of course, it makes sense that our sector is always aware, I wanted to say obsessed with M&A, and that's because of the way that the mining and exploration business is structured, right? We have small explorers, they advance assets to a certain level, and then the best outcome for investors, and usually for management teams, because they have expertise in that phase, is for those assets to get bought by companies that are good at building and operating mines. So M&A is a fundamental part of how our business works. And so there's been a lot of talk about where's the M&A? Well, I think it's actually been fairly present. I mean, maybe it hasn't had quite the gusto that we would like, but these are just some of the deals that are underway right now, right? So these are some major deals. These are big ones. Yes, I have one at the bottom there that isn't actually happening, and Eric and I have some interesting theories about what's going on with Barrick and surrounding Great Bear, and we can talk about those. But I think the cautiousness that we are all seeing first and foremost in the M&A landscape is because majors are terrified of repeating the mistakes that they made in the last bull market, right? Where they just threw billions of dollars of shareholder wealth down the toilet. And I'm glad that they're terrified of that, because none of us want that to happen again, right? And so they are being very cautious. And that has until now meant a focus on dividends and share buybacks and having a bunch of money. I mean, most gold miners are in net cash positions, which is a pretty crazy setup, given the scale of these companies, right? And the amount of, amount of debt that most stocks, in the broad stock market have. So the focus has been on that. It's been on dividends, it's been on share buybacks, it's been on having lots of cash. And of course, we have been in a fairly sideways market, especially in the precious metals, right? So they haven't had their hands forced. Why make a move now when the share price is probably going to be the same in a month, in 6 months, whatever? Obviously, individual stocks have their own individual things going on, but Like I said about opportunities right now, even a bunch of those individual stocks have been marching reliably through their catalysts, advancing their projects, and their stocks have still been sliding because there was this dearth of investors interested in gold stocks. If that is now changing, I feel like it could probably be the accelerator that we have all been hoping for in the M&A space. I mean, major miners are a bit like tankers. They take a while to turn around, so it's not like tomorrow we're going to get 15 takeover deals. But I think that this could be the start of the more dynamic M&A market that we've all been looking for. But I do want to note that that would layer on top of what I think is a market that is seeing deals. Let's not forget that there are deals happening, even if they aren't, you know, taking out the stocks that we specifically own, and therefore we're annoyed that M&A isn't happening. Do I point it at myself? Down there. Okay, that'll work. That's all I'm going to say for today. I have another talk tomorrow, another session tomorrow, and tomorrow I am going to focus on uranium. So those who are interested in uranium, I have spent a lot of time in the last few months contemplating uranium myself and pulling together some data. So if you're interested in uranium, that's what I'm going to talk about tomorrow, what's happening, what I think will continue to happen, and what I'm doing about it in my portfolio. And these are the letters that are offered via Resource Maven. I'm very excited that Peter Kraut is here. Peter joined Resource Maven over a year ago, and we just met in person for the first time yesterday because COVID meant that we hadn't met before. So that's fun. I'm very excited that he's here in person to meet all of you, and of course I love that he has added Silver Stock Investor to the Resource Maven offerings.